Good morning. Happy Friday. We are half an hour from the open. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Annabelle Jewelers.
Our top stories. Asian stocks trade sideways as Wall Street races to a record after better than expected jobs reports, pushing back bets on Fed interest rate cuts.
President Trump scores a major legislative win here as Congress passes his so-called big, beautiful bill, cutting taxes as well as spending on social safety nets and clean energy programs.
Also ahead, U.S. trading partners brace for letters on tariff rates from Washington, which Trump says may be sent out starting Friday.
Plus, Treasury Secretary Scott Bessent says the dollar's place as the world's reserve currency is secure, rejecting the idea of the Chinese currency as an alternative. Right, going into the weekend, so the lack of the lead, of course, is the from U.S. markets, at least because of the holidays. So you're not getting cash treasuries up and running. Although that being said, of course, there's still a lot of news to trade on today. Everything from the payrolls number, from the comments coming through out of the U.S. Treasury Secretary, and of course the outperformance that we've seen now for a third week. In fact, as it pertains to the S&P 500 against most of its peers, it's actually on track for quite a big gap in performance in the last, well, let's call it 10 weeks or so. Now, all that being said, we did also get some data coming through, so we'll recap the Hong Kong PMI numbers in a moment there. So we got that out. We should be getting the Philippine inflation numbers coming through any moment now. And of course, later on in a couple of hours, it's retail sales and that snapshot across the markets in Singapore. Bloomberg dollar, and you have the two-year bond futures, as you can see, so reversing some of the weakness, although it was a substantial drop in two-year futures yesterday. Repricing, of course, on the back of pushing back that first Fed rate cut, which was initially priced before the data came out July, maybe September. That's now being priced fully for October. Currently, that's a moving target, of course. Dollar Taiwan, first close, I believe, below the 29 handle. So we did get that yesterday, and as you can see, reversing that somewhat. And of course, the big story across Hong Kong is when will HIBOR start to reflect all this intervention coming through from the HKMA? Third time this week. I think in terms of the size of what they're actually doing is the one today was bigger than the one that we had midweek, which was bigger than the one at the start of the week. So we'll unpack the story for you later on, and as you can see, some weakness coming through here. Going into the last session of the week, we're watching everything from solar to Alibaba. We'll get to that in a moment, but the opening bell is about 27 minutes away. More on the PMI numbers, of course, which came out.
Yeah, well, they're really not the numbers, I guess, that Hong Kong wants to see, especially on the week where you're marking that 28th handover anniversary to Hong Kong, and it's been that really big talk, or mainland China rather, but that big talk around the economic strength that you're seeing. But I mean, the numbers that just came out earlier, you're going further into contractionary territory. So 47.8, the previous reading had been 49. What do you make of it?
Well, I mean, it's a reminder, I guess, that it is this is a very open economy, right, which is subject to flows when you look at the Hong Kong dollar, for example, and when you look at the trade conversation coming through, that is perhaps a reflection of that as well, right? The weakness still in the Chinese economy, and of course the uncertainty around trade might be contributing to what was, to your point, really a surprisingly low number with a 47 handle.
Yeah, I think especially when I was taking a look at things like retail sales, and you've actually seen them trending up higher over the course of 2025, and we're talking about some signs of resurgence, for instance, in at least new home sales as well in the market. So we'll maybe wait for more context on that. But in the meantime, as you said, it is that big focus on trade and the impact that geopolitical tensions as well have on this city. And to that effort, or to that end, President Trump, for instance, is saying that his administration could begin sending out letters to trading partners, well, as soon as Friday, so later today, but setting unilateral tariff rates ahead of that June 9 deadline for negotiations.
I'd rather just do a simple deal where you can maintain it and control it. You're going to pay a 20% or a 25 or a 30% tariff.
You brought in a record.
And we're going to be sending some letters out starting probably tomorrow, maybe 10 a day, to various countries saying what they're going to pay to do business with the U.S.
Well, our news desk editor, Jill Deeses, is with us. So Jill, I mean, let's just start off with this. Well, we're going to get these letters maybe. Who's going to be receiving them, and what are they going to be saying as well?
All great questions we don't have the answer to, Belle. I mean, this does feel to me like very classic Trump, just kind of saying what's on his mind, and that's maybe what's going to be policy going forward. Really all we've gotten so far out of this these remarks from Trump is that he's saying maybe there'll be 10 a day or something like that leading up to the July 9th deadline. I mean, Trump has made pretty clear that he maybe doesn't really want to extend this 90-day reprieve that he's given on his Liberation Day tariff, so he'd like to have things resolved ahead of then. As of right now, we really don't have a whole lot in the way of deals that are actually done. Obviously, the UK was the subject of really kind of like that first one. You've got China, but that's a little bit of a separate issue there because of all of the sort of the undertones and the undercurrents of the U.S.-China relationship. And then you've got this Vietnam deal that came out just the other day, although now Vietnam's saying actually we're still working on that one. So, I mean, still a lot to come there. So if the idea is that Trump wants to get a lot of these deals resolved by his July 9th deadline, I mean, it could be that he's saying, look, we're basically just going to, slap certain tariffs on there, and that's just going to be it. Again, without a whole lot of details about what exactly is to come. I think we still have to kind of to wait to see exactly where Trump's going with this. I will also, though, say that there's quite a lot of countries that at least are actively trying to continue to hash out their own agreements with the U.S. India strikes me as one really prominent example. They've obviously been working really hard to get a deal. Japan, another one, although I think Japan in particular is a bit of a rocky situation. Trump has kind of indicated that maybe he's not willing to lift certain auto tariffs. But, I mean, again, just bringing those up as examples of nations where there is a lot of impetus to get something done, whether that's part of this letters policy that Trump is now floating. I think that's really unclear, but really does just kind of show you there's still a lot of uncertainty going into that deadline next week.
Jill, just a moment here. There was some breaking news. This Bloomberg scoop of China's plans here to offer more cash handouts to encourage more consumption and spending. In this specific case, our understanding is cash handouts to families as an incentives to have more babies, for couples to have more children, and that the government is set to provide, this is in U.S. dollar terms here, just over $500 US a year for each child born on or after January 1st of this year.
Yeah, and I think also what really stood out in this scoop, really great reporting from our team, but is just how much the birth rates are declining, because if you look at the amount of registered births, it's roughly half the amount that it was back in 2016. So you're talking about over a decade, less than half now that we saw back then. So it's a real issue that they obviously need to address in China, given you do have that overall population decline. Yeah,
well, I mean, kids are expensive, right?
But maybe a bit more than $500 US a year. But anyway.
It is something in that direction. So we did reach out, of course, to the State Council, and they did not reply to a faxed request for a comment. More on that in a moment, but perhaps we're looking at, in terms of some of the baby-related stocks going into the open today, among many, many other things. Right, okay, Jill, sorry. Okay, Bill. Well, on Bill. The big, beautiful Bill, that was a win, at least.
A very big win for Trump.
Yeah.
I mean, this $3.4 trillion spending bill here. Trump seems to have gotten pretty much what he was looking for. It was really only 2 Republicans in the end that sided with the Democrats to vote no against this bill in the House. There was a lot of concern going into this initial vote here, saying, or this final vote here, really saying, the Senate obviously made some pretty significant changes from the initial House version of the bill, looking at deeper cuts, particularly when it comes to Medicaid spending. That's something that the Democrats are almost certainly, I shouldn't even say almost, are certainly going to campaign on when it comes to the next general election. But yes, I mean, Trump made it clear he wanted to get this bill passed by July 4th. That's Independence Day in the United States. Now he's going to be able to sign it, on Independence Day, July 4th. And yeah, I mean, ultimately, it does seem like it came down to trying to bring together, especially those ultra-conservatives that maybe wanted to see even more spending cuts with some more moderate or swing state Republicans who are really worried about the effect that those spending cuts were going to have on their electorate during the upcoming midterms. Seems that they were able to reach an agreement. I think in some cases there was some promises of maybe we can get other issues that you'd like, if you're a Republican, resolved in maybe, some separate legislation. But yes, ultimately, Trump's got his bill. He's going to sign it, and then we'll have to see, what exactly the political fallout, I think, looks like going into the next election.
Okay, that's going to become more clear in the coming weeks here. Jill, thank you so much. Jill Dees is our news desk editor. From one sort of fiscal exercise to another, the breaking news we had out of China here on more subsidies being planned to encourage people to go forth and multiply. Stephen Engel, our Chief North Asia correspondent, is here with us. The chuckle from you. But yes, we have a figure now based on our reporting on this incentive, Steve, to get more couple-fed babies.
I only chuckle because my multiplying days are well over, right? But in China, absolutely, the household expenses have gone way up, obviously, through the growing economy, of course, and the rising cost of living. And then, of course, the scrapping of the one-child policy tried to encourage people to have more babies. It simply hasn't happened. And so you're already seeing the working-age population, the demographic shift is quite noticeable. I mean, the projections are by 2050, it's going to go to either at 1.3 or below 1.3 billion people. They've already ceded the world's most populous designation to India. That happened in 2023. And the real stark projection is by 2100. My God, none of us will be around by then. But the population, 2100? No one's going to be around by then.
Well, I mean, I eat my spinach every day.
Steve, there's a lot of research into longevity. You know, let's not write everyone up.
AI will be around, okay? The projection is to 800 million people in China. Yeah. That would be an amazing drop-off, obviously, as people are not necessarily having births. But this is an interesting policy change because it's widely believed that Xi Jinping is not a fan of welfarism. Is this basically a form of welfarism, handing out cash to families to have a child? Granted, it's not a lot, $500 per child per year for the first 3 years. So potentially about $1,500 if you have one child, and then you can have several child. So this could be we could see the making of a baby boom or not.
Well, it's certainly a big policy push, at least, you know, and maybe that is what it's signalling, that sort of turn or shift to welfarism. But another big policy push, and this is a pivot, of course, but to building those relationships with other parts of the world, and we see that with Europe, but it does seem like they're also having a few hurdles maybe in the way.
Well, sure. I mean, there's no doubt, as evidenced by Wang Yi, the foreign minister is in Europe for this whole week, has been since Monday. He'll stay till Sunday. He is meeting with officials in Brussels, in Germany, in France, clearly sort of setting the table for, in a couple of weeks, this EU-China summit, which we're hearing from sources, the Chinese are not necessarily seeing as many deliverables as they would want, because they usually like to line things up. They know what's going to be announced, especially on their soil. Maybe there's a little bit less clarity because of the rising tension, trade tension, and obviously the geopolitical concerns. Europeans are really adamant about their opposition to China's support of Russia amid the war in Ukraine. Obviously, the Germans are extremely upset over the slowness, like the U.S. is, of the export licenses for the rare earth magnets because of the industrial supply chain in Germany. And then there's the EV tariffs that the Europeans are doing. The Chinese have countered with anti-dumping probes into brandy, into a number of different agricultural products from Europe. So there's a lot of issues. So what we're hearing is that they're going to cut that EU-China summit in half. It's not going to be 2 days in Beijing and Hefei. It's going to be 1 day in Beijing, probably July 24th. Ursula von der Leyen will be there, among other European leaders. But, you know, they need more talking to overcome their difficulties, not a truncated session.
Steve, thank you so much, covering a lot of the big China stories today. And, you know, certainly on one of the things that Steve just pointed out there, the breaking news we had earlier on, the scoop on more subsidies to encourage people to have more children. I mean, it's hard to underscore as well. It does help. And, of course, in many, many places in China, that does go certainly a long way. Market reaction already. Shares of Pigeon traded in Japan now. We're up now 2.2%. This is a company that effectively manufactures and sells baby care goods. There you go. I don't need to tell you when the breaking news hit. We're up 2.7%. We're looking at baby-related shares going into the open today. Speaking of, 15 minutes away, the opening bell, Shanghai, Shenzhen, and here in Hong Kong. This is the China Show. Good morning. Welcome back. You're watching the China Show. So U.S. markets were shut overnight, but again, the headline on this chart is, I guess, in some ways deliberate to encourage debate. Is U.S. exceptionalism back? I mean, certainly when you look last 3 weeks or so, this is the gap between the weekly performance between the S&P and the MSCI World, excluding the U.S., and it's almost a pure contrast there. Bottom is S&P against the other major benchmarks, EM, China, the same one at the top, and as you can see, 24% since about the start of April. Now, all that being said, 51 points was the last trade in the S&P. There are signs, and the graphic's about to show you this, that maybe short-term, the rally might have gotten too far, too quickly. So some of your technicals are about to come up on your screens, things like RSI, stochastics, Bollinger Band. We did close above that level last time we traded. In fact, successive closes above that level. I think we have the graphic. Do we have it, guys, to fire? 26% over 7 weeks. RSI at 75. Stochastics at 95. Do we have it so we can show it? Oh, we don't have it? Okay. I promise I'll show you that later. But yeah, again, Bill, I guess it begs the question, is it back or is it simply repositioning given how extreme things were right before this sort of recent trend started?
Well, I think we've got just the person to put that to, but let's bring in Francis Tan. He's Chief Asia Strategist at Indosuez Wealth Management. So, Francis, what do you think then? Is US exceptionalism back?
Well, I always think that the word exceptionalism is a very newsworthy word. But at the end of the day, if you look at the economic power, the economic size of the US versus the rest of the world, it has always been exceptional. I mean, look at the past 80, 90 years of economic development, how the US managed to bring the overall population up in the prosperity curve. It is exceptional. However, there are, of course, a lot of contenders out there right now. I mean, I can see China is exceptional as well. I mean, look at how China has been over the last just 10 years moving into the technology space. China's speed of exceptionalism is even stronger to me right now. So, but if we are looking at equities right now, I mean, US hitting a record high, and whenever it reaches another record high, the word exceptional comes out again. But to me, it's just that market was a little bit fearful in the past 2 to 3 weeks, and now it's just getting a little bit more on the greedy part. So I think, as we mentioned just now correctly, David, looking at the technicals, it seems a little bit stretched. How long more this stretch can be? It can last for a while more, right. But at the end of the day, it's just cyclical, technical basis.
So what's your advice? What outperforms the next 6 months?
That's right. So remember, if the market is exceptionally greedy, we be a little bit fearful. And if the market is really fearful, we be a little bit greedy. Okay. And I'm not saying go all out greedy, but a little bit more greedy. In this case right now, looking at the RSI, looking at all your technicals, market seems to be a bit more greedy right now. I would say take some money off the table a little bit, especially for clients who are having an outsized position in US equities.
And what do you do then, whilst you sort of take...
Yeah, I mean, if you look at the total portfolio management right now, we are in this part of the economic cycle where I'm a little bit more positive on fixed income. Though many people always think that fixed income means US debt, US government debt, is not true, because fixed income has a big corporate space as well. So right now we are in this part of the economic cycle where growth in the US or in major G7 nations are slowing. We are sort of in the autumn phase of this business cycle that really started in 2020. It's time to take some profits off the equities table and put them some in fixed income, because at the end of the day, fixed income in this part of the economic cycle is an insurance against what we don't know is coming, which is a recession.
Are we sure about where we are in the economic cycle in the U.S.? That's my follow-up question.
That's right.
There.
So how do we determine that we are in the autumn part of the economic cycle? It's very simple. Interest rates will start to move lower. And that's what we are seeing. The interest rate futures are pricing in as well. We are seeing unemployment rate getting a little bit higher from its all-time low. And its all-time low is around 3.5%. When it was its all-time low, it is summer, actually. So now it's climbing higher. But of course, it's anyone's guess where unemployment rate in the U.S. can go. I mean, recent numbers fell back to 4.1. But we have a lot to talk about the labor market.
Do we assume the Fed cuts this year? I think is the other part of the question.
Our house view is that Fed is going to cut two rate cuts this year. Okay. And so long as we are not thinking they are rate hiking, we are in the autumn part of this business cycle.
What about Asia? What's standing out to you?
Well, I'm more optimistic on Asia's exceptionalism, especially right now we are seeing. I mean, who knows what 9th of July will come. But either way, Asia will continue to be exceptional. At the end of the day, if you look at Asia's share of global GDP, it has been rising over the past couple of years. Of course, most recently, we heard news from Trump about some trade deals with Vietnam. Well, that can be part of his art of the deal to show to other nations that, see, if I'm going to be a lot more tough, people are going to kowtow to me right now, right?
But what happens? I mean, you mentioned Vietnam. That's a deal, and I put that in quotation marks because there's really not so much so far that tells us it's anything that's really substantial. So what happens if all of these negotiations become very protracted as well?
That's right. So what I think Trump wants to do right now is to showcase to the world that if I am continuing to be like that, if I don't blink yet, I think countries will kowtow to me. That's exactly what. But in Vietnam's case, it's a little bit different because Vietnam's overall exposure to U.S. final demand is pretty high as a percentage of Vietnam's nominal GDP. It's at around 9.3. And this number is from OECD. It's called trade in value added. So 9.3% of Vietnam's GDP is dependent on U.S. final demand, irregardless of them sending their goods elsewhere, eventually ends up in U.S. So that's pretty high. Of course, if you look at countries that's near to U.S., Mexico is 15.5, even larger. So countries that have a larger exposure of their GDP to U.S. final demand will have a higher probability of kowtowing to what Trump is going to say. But guess what? China is 2.8% only.
Okay, so Francis will be rejoining us for some final thoughts in a couple of minutes. Francis Tan there, Chief Strategist Asia at Indosuez Wealth Management. Right, just under, well, quite literally right now, under 7 minutes away. There we go. 6 minutes and 57 seconds as I speak to the opening bell. 0.7%, 23.9 to the Hang Seng Index. A preview of the trading day just ahead. Happy Friday. You're watching The China Show. All right, welcome back. Very quickly, some things that we're tracking interrelated. I think you have a 7- and 10-year bond sale today, CGB markets. You have solar stocks in focus on the back of some pronouncements. This vow to address some of the competitive dynamics there. Alibaba and, of course, Alibaba Health as a function of that. And the intervention, again, third time this week on the Hong Kong dollar, what that means for HIBOR. And separately, repo rates are at the lowest in 2025 on the overnight and also the 7-day onshore in mainland China, Belle.
Yeah, taking a look at what's happening in the pre-market session here because we're just under 5 minutes away from the open. And we are going to be watching a couple of different sectors in particular. So that's just the broader look here, looking to open under pressure. I mean, it's that big question around Trump's tariffs. What are we going to see with these letters when they're sent out? Yeah. But checking in on some specific sectors and watching the baby-related stocks in particular. Really great scoop that we had at the top of the hour, that China is looking at to subsidizing for parents to have more children. That's around $500 a year. It's going to be really interesting to watch, though, if we see any positive sentiment hold, because names like Pigeon, A2 Milk are already giving up their Is it necessarily going to be super effective? Yeah, $500. Is it per year per kid? Yes, US. Yeah, there we go. Okay, Alibaba, very quickly, a glance at that ahead at the open. Just over 3 minutes away. So, yeah, we'll get to the open just ahead in a couple of minutes. Happy Friday. Good morning. So we are a full session away from the weekend, and we're looking at declines there on Hang Seng. A50 futures are also pointing to a weaker start. In the currency markets, obviously the Hong Kong dollar seems to be very much in focus again, with us pushing against the fence and getting pushed back from it. Apart from that, lots of sectors to watch are going into the open today here, Bob. Yeah, baby sectors, or baby stocks rather, are going to be one key sector to watch because we had a really great scoop coming into the show this morning about how Beijing is essentially planning to offer subsidies to parents to try and encourage them to have more children. But I have to say, we're going into a holiday weekend in the US, but there's actually a lot of different things that we could be tracking ahead of the open in this morning. And I think what's interesting as well is we had that jobs data out overnight, and it was a pretty strong number, and it told us, okay, the Fed, maybe we had these expectations to start the week, maybe we'd see a cut, the first cut around the mid-year. It's been pushed back again to September, but investors are still happy, and we saw US stocks again rising overnight. But today in the session, it's really that big focus on trade, and President Trump saying that he's going to start telling nations their new tariff rates starting today. That big question, as well as we see deals like Vietnam, for instance. I mean, how much substance is there to those sorts of negotiations? What are the actual details? Japan, for instance, we're facing hurdles specifically around rice. And so that is really leading to a bit of concern that you see overall in the session today. But that's what the mainland is doing as we come online this morning. Also taking a look at the Chinese yuan, for instance. We had the currency fixing there pretty much in line with what we saw yesterday, but taking a look at those baby stocks in particular, as I said. Hong Kong in the session as well. Very interesting eco numbers that we had just in the last hour, but the Hong Kong PMI, I think, would be... I still find it slightly surprising because we saw it coming further into contractionary territory. So a reading of 47.9, is that right, for the latest one?
Yeah.
Around that point. Anyway.
Academic. But 47 was, I think, the key there.
Yeah, and importantly, deterioration from the month prior. And so the concern there is, again, is really what is that indicating to us about the health of the economy, the health of the private sector here in particular, especially as you see other really big talking points, which is, you know, the Hong Kong currency intervention. Yes,
third time this week, and the buying of the dollar has been incrementally bigger over the last three sessions or so. Now, the other thing is, HIBOR hasn't really responded so far, and the more they do that, the more HIBOR will respond. And to what extent they could actually disincentivize a lot of the Hong Kong dollar as a funding currency, I guess, in the short positioning there. But anyway, yeah, that's a big talking point here today.
And Alibaba as well, I think, is another big talking point, because just taking a look at how these stocks are coming on, Alibaba is standing out to the downside, 1.5% off, even though it is broadly risk off. But Alibaba looks to be one of the big decliners so far in the session. They are looking to essentially raise more cash. They're offering exchangeable bonds, for instance, of Ali Health. They're also looking at offering Alibaba Health shares, rather, in a Delta
discount
placement.
Yeah, I'm looking at that. If we could just show that to our viewers. So Baba's down about 1.5 as Bell is pointing out. Oh, okay, here we go. We're down 8% now on Alibaba Health. That's going to come up on your screens very, very shortly. That now takes declines in the share price from the start of the month. Rough math is about, I'm looking at nearly 15% now on shares of Alibaba Health. And of course, that big news came, I think, after the close yesterday. And of course, U.S. markets were closed and non-reaction there. But yes, rare earths too, I think, are in focus.
Rare earths, yeah, you can see the Alibaba Health, but off 7% here. Shares had been offered, as we said, $4.18 to $4.28 each in that Delta placement. But yeah, rare earths, another big one to watch, because I think, again, you see China really putting its foot forward to try and shore up relationships with other parts of the world. The EU, of course, and we've seen Wang Yi, for instance, on his tour of Europe this week. They're planning ahead for a meeting in China later this year. It's just been sort of downsized a bit, but they are saying that they're going to be speeding up rare earth approvals for the EU, and that has been a big sticking point in the negotiations as well.
Yeah, and amidst the back and forth on trade and the uncertainty that remains in many parts of those trade negotiations, one asset that's done very well is gold, right? In fact, what do you do with gold? In fact, when you look at the first half, it's been equities and gold as really the outperformers. Do we continue to lean into that outperformance? Francis Tan is still with us here, Chief Asia Strategist at Indosuez Wealth Management. What do you think about gold?
Well, the allocation of gold, I think, is important for any portfolio right now, especially when the market is getting a little bit more uncertain to what the future will be like in terms of economic growth. But of course, there's a rule of thumb in the field of finance. We always say that, allocation to gold should be around 5 to 10% of portfolio. The question that I always get is, so is it 5 or is it 10? Now, that really depends on what you feel about the upcoming 6 months to 1 year growth opportunity. If you think that the equities are currently pretty high up in terms of valuation, which is exactly what we are seeing right now, all-time high, then it's time to increase some allocation to gold. Yeah.
Well, what do you think? Is 10%... Something that I've heard recently is 10% might be on the low side right now, given the sort of structural flows into gold. What would your advice be as a counter?
It seems like gold is glittering a lot right now. It really depends, again, on the business cycle theory that I was talking about just now. Well, if we are in the later part of a business cycle, you should increase your allocation to gold. But it really depends on the risk profile of a portfolio. Yeah. There are investors who are aggressive. There are investors who are a lot more conservative. It really depends. But right now, I would say that if it's going to be only 5 to 10%, you should garner something that's nearer to 10%.
Okay, Chinese equities. We just had an open today. You said you're mainly constructive, of course. This China exceptionalism, I think, is the phrase you used earlier on. What would you advise people to buy in China at this point?
That's right. For me, I will say that China will be a long-term accumulation strategy for clients, for investors right now. Do not excessively trade China. I mean, you're going to come out disappointed, especially over the last 3 to 4 years. A lot of people that I met has always said that, oh, China seems to be uninvestable, or rather China is uninvestable. I don't think so. Because if you look at China's position as some of the strong tech players around the world, the innovation that China has, and if you just do a quick ChatGPT or whatever, or what are the top technology that China is leading the world right now, that's a lot. If I'm not wrong, 37 out of 40 something. That's amazing. But it can't be at such valuation right now, right? Because of a lot of external forces, because of the US hammering China, because they are the second student in the class. They can't win the top student of the class. The top student of this class is so afraid of the second top student right now. But what China is doing, I believe, is offering a lot of undervalued technology companies. So if you're into China, do it using a dollar cost averaging approach to accumulate Chinese tech.
Which parts of Chinese tech, though?
Okay, of course, there are platform Chinese techs, there are innovation Chinese tech, there's AI Chinese tech. And if AI is going to be the future, and if you think that Chinese AI will be one of the strong contenders in the world, AI-related Chinese tech will be one of the key things. Quantum computing, big data analytics, all these things will be the key ones that we are looking at still.
Anything to avoid? Not just in China, like anything in general that you think is a mistake?
Well, if you have seen the most recent construction real estate numbers coming from China, it didn't tick up higher. New home sales, even the existing home sales, it moved a bit lower again. So I think for now, we would like to hold on in terms of any exposure to Chinese real estate for now. Yeah.
All right, Francis, thanks so much for joining us, and definitely come back to us next time you're in Hong Kong. That was Francis Tan, their Chief Strategist Asia at Indosuez Wealth Management, and I think a really good launching point, of course, from a China property back into Hong Kong's property sector.
Like we planned it.
Did we plan it?
Yeah. Well, let's
take credit for it. Okay,
let's say we planned it. Bill, come on.
All right, the developer New World, let's get more on that because it's planning to raise as much as $2.2 billion through a new loan. That's just days after closing a record $11 billion refinancing deal. Our credit reporter, Trista Shinyi Luo, is with us this morning. So Trista, I mean, what do you think the market is going to make of this? It's certainly, I guess, perhaps a step in the right direction.
Yeah, I think people are keen to see whether New World can close this deal because it's the first task for New World to raise fresh money. We know that New World has closed its mega refinancing deal earlier this week. And right now, I think the whole market is keen to see whether they can close this one. And we know that the current commitment deadline is July 11th, so which is next Friday. Yeah.
Do we know? Well, how much do they need further? I think, people were talking about the $11 billion. Now that's done. They're talking about another $2 billion. Is there any indication that this might be the last one, or do you think they'll probably need to raise more money and shore up financing?
Well, I think obviously the developer wants more money, right? But it really depends on the reality. I think they are trying their best to using the Victoria Dockside right now to raise the $2 billion loan. I think right now, I think investors are looking at this because we know that a lot of banks already have a lot of exposure on Hong Kong real estate, especially on New World right now. So we reported earlier that the Deutsche Bank, which is the arranger for this new loan, sent another round of invitation letter to more banks in late May. So and we also reported that some banks are already say they're maybe reluctant to join this new loan because they already have a lot of exposure. Right. So we need to see how it goes.
Have we heard from New World on this? No. Okay. Well, as of now, of course, this is a reporting, and you can get more details of that, of course, on your Bloomberg terminal and also on the website. Trista Shinyi Luo, there, our China credit reporter. Let's stay in Hong Kong, right? Because certainly lower rates have helped, but certainly lower rates have resulted in, I guess, in chicken and the egg, a weaker Hong Kong dollar, and the HKMA has again defended the currency peg, third time this week. Let's bring in our Asia FX and rate strategist, Stephen Chu, who joins us right now to talk us through this. And Stephen, do you get a sense that the HKMA is just in the early innings of trying to get the exchange rate back towards the middle and trying to get, and why haven't rates in Hong Kong responded to the upside is my other question.
I think given the peg arrangement, we all know that it's a matter of time. It depends on the US-Hong Kong gap, and the gap is still so large right now that you will just keep pushing the spot towards 785. And the speed of draining liquidity, whether it's these 2 days or last week, it's just too slow the aggregate balance is still over 100 billion honky. And we remember it has risen all the way from below 50. So probably we need to see faster drain, talking about all the way back to below like 70, 80. Then we can see a more meaningful rebound in HIBORs. Then it will close the US Hong Kong gap, and we can see spot back to 780 or even below. But for now, it's still so slow. You can almost feel that the HKM may want to do it gradually to keep rates low. A lot of people speculate about the New World situation. Of course, we can't prove that, but you can see that compared to early May when they sort of like inject liquidity, they are basically draining at a much slower pace right now.
How long does this extend for, this situation? I mean, we've seen 3 bouts of intervention in the space of just a few days. What do we look like, I guess, over the coming weeks?
Yeah, to be honest, it's just a pure guess because it can be a matter of a few days or a week to basically sort of spike HIBOR up. Depends on like how they want to do it. It's really a wild guess, but if you ask me, by the end of this quarter, I think there's a very high chance that we're going to see HIBOR back to like 2 to 3% range compared to now. So it's really a matter of time, and it's getting harder to sustain that. As you can see now, if the dollar strengthens again, especially with that US Hong Kong gap, all the factors are pointing towards more intervention from the HKMA.
All right. Well, I think, Stephen Chu, your glasses might just end the peg alone. Just looking at that. Kidding. Stephen Chu there, of course, with what look to be candy cane glasses shaped into a circular form. Our Asia FX and rates we're circling back again to this topic. Beautiful morning here in Hong Kong as we weave ourselves quietly into this weekend. This is a China Show. Welcome back. Reuters is reporting that the U.S. is allowing GE Aerospace here to ship jet engines to China's COMAC. Danny Lee, our aviation reporter, joins us now. Yeah, Danny, what do we know?
So we know that the U.S. has been allowing companies or telling companies in the U.S. that they now have the licenses that they can now export critical parts to various firms. In this case, we understand as well that GE Aerospace has been told by the US Department of Commerce that it can now restart jet engine exports to China. And in turn, this benefits COMAC, Commercial Aircraft Corp of China. They supply a rivaling jet than what Boeing and Airbus does. And so therefore, this is a good news for China, and particularly when you talk about the broader themes around trade, the easing on the likes of chip curbs on jet engines and other critical technologies is a clear sign that between Washington and Beijing that there is some kind of positivity in the trade talks between the pair, the two biggest economies in the world. And so I think this is a very, very good sign, particularly as China was very unhappy with the late stage export curbs on things such as jet engines. So I think we can see these movements in the broader context of trade and where we potentially go from here.
Yeah, the jet engine is certainly one hurdle for COMAC to overcome. I mean, but if you take a look at the C919 jet, for instance, a lot of its components do come from abroad. What's the sales pipeline looking like for COMAC overall?
Well, the sales pipeline is still very heavily focused on the domestic China market and customers. And so I think this is one of the things is going to be of still concern to foreign airlines is can they get a guaranteed supply of parts that they'll need not just for delivery, but for constant service and maintenance of aircraft. And so therefore, for foreign airlines, there has been this discouragement of looking at COMAC when it comes to buying aircraft purely because, this risk, this geopolitical risk of the threat of exports or the suspension of exports could impact operations. So very much China and COMAC looking to broaden its wings as it were, but still very much looking to its home market to boost supply, which it has already taken. There are hundreds of orders in the meantime.
Danny, thank you so much. Danny Lee there, of course, with the latest on that. And I think, I think the news this week, I think I saw that, of course, COMAC and the first international flight, I believe, which was to Mongolia. I think that goes nicely into this next report that you.
Well, I think it's really interesting
well. Yeah.
is obviously China has that continued drive for self-reliance, and you see that with COMAC, where they're looking at something that can be disruptive to Airbus or to Boeing. But you see that as well with their military weapons. And this week, for instance, we've had the Shandong aircraft carrier coming to Hong Kong for its first time ever. And what's really significant about the Shandong is that this is the first time that they could ever build their own aircraft carrier, and it certainly is something that could end up being a challenger to US naval dominance as well. But just take a listen. Aircraft carriers are a crown jewel of modern militaries. They enable nations to project power far beyond their shores and act as deterrents by discouraging would-be adversaries from escalating conflicts. Only a handful of navies operate these vessels, with the US having the largest and most advanced fleet in the world. But China is on a mission to catch up. Today, the country has 2 aircraft carriers in active service, the Liaoning and Shandong, with a third, the Fujian, undergoing sea trials. Together, they represent an evolution. Initially, China acquired and retrofitted Soviet-built technology, then progressed to making its own. With both the Shandong and Fujian showcasing enhancements in design and capability. Now a 4th type is in development and could be the first fitted with nuclear propulsion, potentially levelling the playing field with American ships. China wants to become a global Navy superpower, with the Shandong entering Hong Kong waters after another first for the PLA, this time on the tactical front. Both the Shandong and Liaoning were sent to the Western Pacific in June, conducting exercises beyond what's called the second island chain. It stretches from Japan into the Central Pacific and is often viewed as a strategic framework for Washington and allies to contain China during potential conflicts. Beijing's maneuvers beyond this point signal a new phase of operational readiness, with the vessels learning to coordinate in open waters. While such activities are permitted under international law, the show of force is notable. Analysts say the tactic could be used by China to deter US forces in the event it launched a military operation to take Taiwan. Annabelle Drulers, Bloomberg News, Hong Kong.
And you can get an insider's guide to the money and people and the stories, including this one, of course, which was the big one this week, shaking up the finance hat, our Hong Kong edition newsletter. The latest one was out yesterday. Check it out on Bloomberg.com/newsletters. U.S. Treasury Secretary Scott Bessent is dismissing the idea that the dollar's recent weakness is actually putting its reserve currency status at risk. Now, Bessent told us that the White House is taking steps to maintain the dollar's role.
The price of the dollar has nothing to do with a strong dollar policy. Current currencies move up and down based on a variety of factors, but a strong dollar policy means several things. One is what is the dollar strong against, or is another currency stronger, higher in price at the moment? That doesn't have anything to do with a strong dollar policy. The strong dollar policy is, are we doing the things over the long term to ensure that the U.S. dollar remains the reserve currency of the world? And we are. We are setting the stage for economic growth. We are constraining inflation. We are making the United States the best destination for global capital. And I think that's going to continue to happen. I think, as I said, many times over since World War II, the demise of the dollar as reserve currency has been predicted. And I think once again, the skeptic is going to be wrong. But there is no change in policy.
Fair enough. But I'm sure you understand that the weakness that we've seen in the dollar to start the year is something we have not seen in decades. And there are other countries that have been trying to take advantage of it. In a speech just this week, we heard from the Chinese central bank governor, who really laid out at least their vision, their Chinese vision, for a new global currency order. quarter, which would, of course, mean a reduced role for the dollar and, in their view, a greater role for the yuan. Now, regardless of whether that is a viable plan, I am curious as to what you think about the idea that this is even being spoken about publicly.
Well, I mean, look, what are the Chinese going to say? And by the way, it's a complete fallacy. They have a non-convertible currency. So how are they going to be a reserve currency? They also have 1.4 billion people who want to get their money out of China. They have capital constraints on taking out money. The sine qua non for a reserve currency is that it trades freely. And I saw my friend Christine Lagarde, president of the ECB, the other day, said that maybe this is the euro's moment. But I can tell you, if the euro hits 120, Europeans are going to be squawking that it is too strong. They are an export economy. So let's see what happens. They should be careful what they wish for. Whereas in the United States, we recognize the responsibility that comes with being a reserve currency.
That was the US Treasury Secretary Scott Bessent there. A really great interview, and we've been able to obviously catch up with him a few times this week, but a very pivotal week given we've got that big, beautiful bill as well that's been passed. But taking a look at how markets are faring in the session so far today, and we are seeing them mostly under pressure so far. Hang Seng Tech is leading the declines here, 1.8% off. I'm pretty sure Alibaba is going to be playing into that, given we've seen weaker sentiment for that. They're raising debt to try and fund their AI needs. We'll have more details on that ahead. You're watching The China Show. Welcome back. You're watching The China Show this morning, and we are looking at a pretty downbeat sentiment day, actually. Coming into the session, I mean, we had sort of two different things we were watching. Jobs report from the US. US markets liked that. Trump's tariff comments have definitely overweighed any sort of optimism from that, because we're seeing markets that are sort of under pressure here this morning. What's leading the decline so far are the tech stocks in China in particular. I think Alibaba is probably really playing into that, given that they're offering exchangeable bonds, for instance, to try and shore up some cash to then put into their AI efforts. But certainly that is definitely weighing on sentiment. Biggest drop for Hang Seng Tech in 3 weeks.
Yeah, and I mean, the whole narrative around whether equity markets, particularly in the U.S., to your point that markets are liking this, are complacent given its summer months. And, you still have that July 9th deadline coming through, and the fact that we're not really getting a lot of traction on many of the trade conversations taking place. We know many people want to deal, but it doesn't seem we're substantially close to getting one along the major sort of trading partners. And separately, of course, between the Chinese and the EU, for example, we know some of the challenges that have emerged recently there as well. So you get a sense that we kind of know the risk, but are people ignoring the risk is what I'm trying to get to.
Yeah, I think these as much as you can try and aim for trade deals, at the same time, it doesn't really remove that broader sticking point, which is that intense competition and the effects of that. And I think it's really great, actually. We've got Graham Allison coming up just in a few minutes, because he can talk to us as someone who really popularized the term the subsidies trap, and could actually China overtake the US without causing any sort of kinetic conflict or conflict at all. But markets today, as you said, it's really trading off that trade tensions theme, and also another interesting one, which is the baby stocks. we can't go without mentioning that. It's been a really great scoop that we had just in the last hour, but essentially the Beijing government is looking at trying to encourage more parents to have kids. They're offering a subsidy of $500 or just over $500 per year per child for the first 3 years for any babies born after January 1. We've seen some optimism in stocks, but certainly have come off the highs of the day, and I think that really points to that big question. Is this actually going to even work? Because you take a look at birth rates, for instance, they're more than half the amount they were going back 10 years ago.
It's not just about money, right? There's a change in the mindset taking place. And again, it's just to underscore, right? This is not just a China issue and phenomenon. It is certainly in China's case a more perhaps pressing one, given just the curve of, China gets older before it gets rich. and the struggles around getting consumption up and running against the backdrop of things like the property prices, for example. Too many apartments being built for too few families wanting to start a family, I think is the way I'm going to tie those two things together there. But yeah, I mean, to Bell's point, Pigeon was up as much as 2.5. We're now effectively flat just an hour after that news dropped. On Alibaba and Baba Health, and of course the exchangeable bond and the story that dropped 2.7% on Baba. Health is down about 7.5%. And the broader read across these markets, Asia Pacific, U.S. futures, the dollar, and two-year futures, which are currently on the two-year futures reversing the weakness that we had on Thursday following the jobs report, seeing some gains there. So all things equal, markets are now expecting the Fed, the first cut to be sometime in September or October.
Yeah, and it's a big change, I guess, from where we were early this week because we had been looking for a cut as early as the midpoint of this year. But September is now the base case once again for traders. But going back to trade, of course, it is the big story for us in the market today and why we're seeing markets under pressure. President Trump saying that his administration may begin sending out letters to trading partners as soon as today, that's Friday, setting unilateral tariff rates ahead of a July 9 deadline for negotiations. Our senior editor, Bill Ferry, is with us. So, Bill, a lot of, I guess, lack of clarity so far, not just on the negotiations we've seen, the sticking points, how they're faring, and who's going to get these letters and what's exactly going to be contained in them.
Yeah, you said it right there. I mean, at one point in the beginning of this process, the administration was talking about making 90 deals in 90 days. We are very far from that, and it does seem like President Trump is at least personally frustrated or basically done with the negotiating process, saying that he could start sending out 10 letters as soon as Friday in the U.S., just basically letting countries know what their tariff rates are. So far, we really haven't seen a lot of deals made. We've had agreements with the U.K., with China, most recently with Vietnam. But we don't really even have the details of that Vietnam agreement at all beyond a 20% general tariff and a 40% on transshipments going through Vietnam. So we don't know if there are lower rates or different rates for other products or anything like that. So I don't know if we'll see like a blanket list of countries like we did on April 2nd, just showing a kind of a random collection of tariff rates. But I think markets and governments are bracing themselves for news that could come as soon as later today once the U.S. wakes up.
Bill, thank you so much. Bill Ferry is there, our senior editor in Singapore, for us on the latest on this specific of multiple negotiation fronts and talking points as we, I guess, try and get more sense of how these trade deals will look and, more importantly, how the trade relationships look on the other side of any potential agreement coming through across these multiple fronts. Now, on that note, and we talked about this just a few seconds ago with Annabelle here, you have Chinese governments in the meantime here is said to be considering shortening this planned summit later this month with European leaders. That's even as Foreign Minister Wang Yi visits Brussels, now saying that the two sides must avoid confrontation over the differences and their disagreements. Now, our next guest recently met with the Chinese foreign minister. Graham Allison is the Douglas Dillon Professor of Government at Harvard University. Graham, a pleasure to have you on the show. Lots to talk about and unpack. Good morning, by the way, from the Asia Pacific. I guess I want to start off with just give us a sense of what the tone and the message you're getting based on your conversations with top Chinese officials. Of what does it feel like currently to you?
Well, good question and a pleasure to be with you. I think that I had a great opportunity to spend an hour and a half with Wang Yi last week in Beijing. He and I have had a number of conversations, mainly about geopolitics. He and his boss, Xi Jinping, have embraced the diagnosis in my book about Thucydides' trap and Thucydidean rivalry, and are deeply concerned about the ways in which history as usual would lead to a catastrophic conflict and what they can do to try to avoid that. He's an extremely talented diplomat. He knows his brief and he knows his position. He has worked very closely with Xi Jinping, And I think the bottom line is that they feel like they are in a very comfortable position. They think they're prepared for the turbulence ahead. You maybe remember a couple of years ago, Xi Jinping shocked many people in the world by saying he was expecting changes the like of which has never not been seen in 100 years, and people making fun of that. More than 2 or 3 people reminded me of that when I was there last week, that looks like a little bit better prediction. They think they're prepared for turbulent waters. They think they have a good helmsman. They think they have a good team. They think they have a good hand. So I think this is stay tuned.
And I'm assuming, based off that conversation, you felt confident enough at the World Economic Forum in Tianjin to say that we'll see an MOU soon. When exactly do you expect to see that, and what would be the contents or the rough contours of that as well?
Well, that's a good question. Thank you. Again, given the unpredictability of the Trump administration, and the uncertainty about what's going to happen on July 9th. I mean, here we are just five days away, and we don't know whether there are going to be agreements or whether they're going to be extended, which is what Bessent obviously hoped would happen, or whether they're going to send out some letters. So this all seems rather chaotic. And actually, from the Chinese perspective, again, playing into competition with the U.S., I'm sure a big part of the message that Wang Yi has been sending, both explicitly and more just by his presence, is that here's China, stable, predictable, ready to do trade deals, eager to do more trade business, and making the sharp contrasts with the U.S. So I think that's the one side of it. I suspect, though, that for the China piece, since they've already gone through 2 rounds of this, they will count that as one of the areas in which they've reached some level of agreement. First, in the discussions in Geneva about bringing down the extraordinary trade tariffs that Trump imposed in the first case. And then secondly, more importantly, in the control of exports, key items, including rare earth magnets. So whether there'll be another I'm confident the logic of the situation would say this is going to lead in short order to another release of some version of an MOU that'll be more specific about how they're limiting, on the one hand, U.S. constraints of items that China needs badly, and on the other, China's constraints of rare earth magnets, without which Ford Motor Company can't run their production line, and F-35 lines can't produce new airplanes. So this is an area where I think we've been reminded how deeply entangled the 2 economies and their supply chains are, and how adults are going to have to then, and I think we do have adults on both sides working the problem, going to find their way to an uncomfortable accommodation in which we'll stumble forward. That'd be my bet.
So this MOU that we could receive, is that going to be the same as the trade truce that Howard Lutnick said that the US and China had signed, or are we expecting something, again, additional there?
My impression, again, both from just the logic of the situation, but also sort of reading a little bit more into what conversations I have both with folks in Washington and Beijing, is that they've had a working group working in pursuit of the discussions that occurred both by the Secretary of the Treasury and the Secretary of Commerce, trying to spell out in a little bit more detail what the rules of the road are for both the trade and the export controls in particular. So I would suspect we'll see something, a written product on that in the not too distant future.
Graham, maybe just to dig deeper there, because it seems this has gone beyond, to your point, more than just a framework around a trade relationship, right? You mentioned rare earths. I think you alluded to access to chip technology. And I wonder whether you get a sense that China is directly asking the U.S. To give them access to chip technology as part of a broader deal.
Again, I have no information about that. But again, the logic of the situation would suggest that they would be doing so. since that's been one of the constraints that we've imposed that they don't like. And they have demonstrated that they control a dozen items, maybe 60 or 70, which they can squeeze at their own discretion and which we find difficulty living without. So if you just take that as in a game theory perspective, and you play A and I play B, and we say, how does this play out? I would say we're likely to see some erosion on the chip constraints.
Graham, maybe just to rewind a little bit, one of the sticking points, and I want to use past tense here, and I wonder if you could give us insights on this. One of the sticking points going into the trade talks was China felt slighted, disrespected, and not knowing what the U.S. wanted. Are those still sticking points you feel based on your conversations with officials, or in other words, are negotiations now on much equal footing as the Chinese had wanted?
Again, a great question, and it's got multi-levels. I think you have the Chinese like stability, predictability. Chaos is kind of their nightmare, and it's hard to deny that the Trump administration seems chaotic, because I think it is. And on the other hand, in the relationship between President Trump and Xi, there's a great deal of mutual respect. They've exchanged a number of communications, including not just their phone calls, but letters and otherwise. And Trump has said over and over that he greatly respects Xi Jinping, that he actually admires him. So I think among American political leadership, the most positive person in the whole system about Xi Jinping and his China happens to be the president of the U.S. I think they appreciate that. So again, my impression is that this should lead over time, and not too long in advance, to some meeting between the two presidents in which they, in effect, offer their view of what the relationship ought to look more like. Now, go one level below that to the current leadership in the U.S. government, and go 2 layers below to the departments, and then 3 layers below to the politics. Most all of that is quite negative about China, but the least hawkish person about China in the American government just happens to be the president of the United States. So again, this is, you couldn't make this up. It's going to be too interesting to watch going forward.
Yeah.
You're right. That's certainly true, Graham, and we know those invitations have been issued on both sides for visits. Graham, please do stay with us because we've still got some more questions for you on where the relationship goes next. But Graham, Allison, Professor Douglas Dillon, Professor of Government at Harvard University, sticking with us. We'll just go to a short ad break. Plenty more ahead. This is Bloomberg. We're watching the China show, and we've been speaking about where the relationship between Washington and Beijing goes next. Still with us is Graham Allison. He's Douglas Dillon Professor of Government at Harvard University and rejoins us now. And Graham, we were just speaking about how you had a 90-minute sit-down with the Chinese Foreign Minister Wang Yi. And I want to talk about this need perhaps that we have now for a Henry Kissinger-style go-between the two administrations. I mean, you once studied with him. You've also been served in both the Clinton and Reagan administrations. I wonder what you think about the need for that type of role, and who you think could be the one to fill it as well.
Well, that's a good question. I think certainly Henry played a unique role, and I don't think it's likely that anybody will be able to play an equivalent role. I mean, he was able, when talking to somebody like Xi Jinping, to remind them, or they were reminded, that actually he was there at the beginning. So he was there with Zhou Enlai and in the opening to China and the original conversations with Mao and ultimately the Shanghai Communique. And then Henry was Henry. I was a student and he was my mentor. I loved him, learned a lot from him. But nobody's going to replace Henry. On the other hand, the Chinese have a great deal of both cultural and historical respect for people that are old. So I at least qualify as aged, who may be professors, and Harvard they have a favorable view towards too. So I've been privileged to be part of conversations with them about basically the geostrategic situation. And since the book that I wrote that was published back in 2017 called Destined for War, Can the U.S. and China Escape Thucydides' Trap, is a favorite of Xi Jinping. It's obviously a favorite of all the people that work for him. So they've been fascinated to want to discuss Thucydides, whom they hadn't learned much about earlier, but now they have, and his analysis of the ways in which when a seriously rising power threatens a major ruling power, most often that leads to war. And they like to understand patterns in history. And then in particular, the question of how war can be prevented. So the basic bottom line in the book that the Thucydides Trap book is that if all we can manage is business as usual or diplomacy as usual or statecraft as usual, then we should expect history as usual. But that defines for us the challenge. Thucydides was not fatalistic, and I certainly am not fatalistic. I think left to its own devices, this relationship most likely to go the way of history, even to a tragic war. But I don't think that's necessary. And I'm hopeful that under Xi and under President Trump, we're going to make a turn towards a more constructive relationship. I know that sounds a little Pollyannish, but that's my hope.
Well, I'm curious about that because I think in the book you looked at 16 historical cases of a Thucydides trap where 12 had ended in war. So certainly history is the guide. That is what could happen. But what exactly then do you think needs to take place for that situation to be averted?
Well, again, let me stretch my imagination to the positive. So both Xi Jinping and Trump have said repeatedly, and Trump most vehemently, he says, I believe the U.S. and China working together can solve almost all the problems. So if you look at Trump and his history and what he says and try to read between the lines, I think he can imagine that he and Xi could be he could be a great deal maker. Trump could be a peacemaker. He and Xi might redefine the relationship. So when you say U.S.-China, I think the first word would pop out of your association would be partner as opposed to enemy or adversary. Now, is that possible? I would say not likely, but impossible, no. Particularly if they begin to work on some problems together. Now, what could they work on? Well, how about bringing into the war in Ukraine? Trump imagined that he could do that in 1 day or 1 week or 1 month. Here it is now a year. Who could help do that? Xi Jinping. What about fentanyl? I think the Chinese have already done a lot on the fentanyl front, and I think if you imagine Xi and Trump sitting down together and saying, okay, whatever you want to do about fentanyl, we're doing it. You just put it on the list. That's an easy win for Xi Jinping. And on the trade front, I think Trump is delusional about what he thinks trade can do to improve the U.S. economy, but he's not dumb. And when he runs up against a wall or up against Mr. Market in reality, he retreats. And in the relationship with China, the trade, which started off as essentially an embargo with 145%, was hurting the U.S. economy. So again, he reduced that. The export control efforts, when China pushed back, we basically backed down. So again, I think logic would suggest that this is going to be a very uncomfortable, uneasy relationship, but could involve at least as much partnership as it does confrontation and conflict. I think that's at least what, I think if Trump had his druthers, that's what he would wish for. Now, between an aspiration and an accomplishment, quite a long road, but I'm trying to be hopeful.
Okay, well, I guess on that hopeful note, encouraging one, to say the least, Graham, we thank you so much for the time, and let's do this again. Let's do this again soon. On, before, or maybe after your next potential meetings, who knows? Terrific insights into what's going on there. They probably need someone like you, is what we're trying to get to there. Graham Allison there, Douglas Dillon, Professor of Government at the Harvard University. Plenty more ahead here on The China Show.
We are taking a look at how rare earth stocks are performing this morning under pressure, even though you have seen China looking to accelerate the path toward approving for the EU. We know that any sort of delays on that are being taken very seriously by the bloc, and it has become a real sticking point as well in the discussions. A reason perhaps a planned summit for later this year in Beijing between China and the EU could be looking to be scaled down. But we'll have more details ahead. You're watching The China Show. Welcome back. Taking a live look here at a live picture of Mumbai this morning. But the big story that we've got this morning is that the Indian securities regulator has restrained Jane Street from accessing the local securities market, and they're citing essentially alleged unlawful gains of 48.4 billion rupees. And so the regulator, the SEBI, has directed banks to freeze Jane Street's accounts and prohibited the firm from buying, selling or dealing in securities until the matter is resolved. We've just had some commentary back from Jane Street. They're saying they're looking to further engage with the Indian regulator, and as well they do dispute the findings of that interim order too.
Yeah, that's a big story, actually. Yeah, we'll get more details on that certainly coming through here on the China Show shortly. We'll set that aside for now once we try and get more understanding and details of that. And one of our top stories, just to pivot back here, this morning was President Trump talking about how the White House may be, sending out letters to trading partners as soon as Friday, I imagine that's U.S. time, setting unilateral tariff rates ahead of the July 9 deadline for negotiations. Now, he had earlier announced a framework as far as deals go with the likes of the UK. Most recently this week, he mentioned the one with Vietnam, as well as a trade truce with the Chinese.
Yeah, and aside from tariff developments, investors and companies are also trying to grapple with geopolitical risks. So a new survey of CEOs and board members by management consultant firm Korn Ferry has found a distinct lack of confidence about handling such risks. For more on how corporate leaders are navigating uncertainty, let's bring in Korn Ferry APAC President Esther Colwill. And Esther, thanks so much for joining us this morning. I think it's quite hard, really, to separate tariff risks from geopolitical risks these days, but talk us through the key findings then from the report.
Yeah, certainly. It really is. And we've seen that particular risk on any risk survey has come to the top, and it is top of everybody's mind. No, I don't think you can separate tariff risk because it impacts everything. Even if you're a CEO of a company that only operates in one geography or even one country, whatever else is going on globally is going to impact you. It's the area that leaders feel that they've got no control over and often very little influence over. And so what we are seeing is a need to develop global fluency, much, much deeper than it has been in the past. Leaders really need to develop muscle around geopolitics.
Right. And what are the specific manifestations, I guess? How has that showed up in your practice?
Yeah, so we see executives looking for very specific roles, global or corporate affairs, really finding ways to get experts to help them tune out the noise. Okay. There's so much daily noise and news, and that's the world you live in. They have to look to the longer term and keep a steady hand. Next week's going to be a huge week, but they still have to keep a steady hand, whatever the tariff news comes out with, knowing that in weeks or months it will probably change again.
What does CapEx look like? I mean, if you sort of just peel it back a little bit and look at what the Trump administration is, or what they're partially trying to achieve here is reshoring or onshoring a lot of these technologies. Do you actually see those commitments starting to come through, or CEOs and other executives just still waiting to see what actually comes out in the end?
CapEx isn't moving that fast. Certainly, I think that's everything that we're seeing and many executives are seeing. Even before the Trump tariffs, however, we were seeing a lot of trade shifts move. Historically, of course, Asian economies have been very export-oriented. That's been the success. That world has really shifted. China has diversified incredibly. We see the Middle East and the GCC countries really looking to move to Asia and look east rather than just to America. And so from a global GDP perspective, that's really encouraging, that level of diversification.
What does it mean for CEO turnover? I just want to get a sense of that and why it affects that.
Yeah, so CEO turnover has been a record high in the US and EMEA this year. However, it has actually dropped in Asia. And so one of the conversations I've been having this week is, why isn't it happening, or isn't it happening yet? And our team are having a lot of succession conversations. They're having a lot of leadership development conversations. And the view is that that is coming. For family offices, some of the older founders are now really handing over because it's a different world and a different economic set than they grew up with. And we do expect to see a lot more turnover in CEOs coming for Asia.
What does it mean for pipeline, too? Like, what is pipeline looking like? Is there enough pipeline in the Asia-Pacific? It's something I don't think we're very much used to just yet.
Not yet. Not yet. There's definitely been a historic reliance on Western talent for executives coming. That is improving, I would say. And it is no longer the default. So, for example, looking for executives in Japan, they will look to Hong Kong, they will look to Singapore, they will look to India. So it's not just the default any longer. It's growing. It's getting better.
What does the overall what are the compensation trends that you see as well? And you mentioned that that battle for talent. How is that actually playing out?
Yeah, talent always gets paid at the top level. The very best performers always get paid very, very well. Beneath that, we're seeing a lot of flattening, a lot of freezes. Bonuses are not necessarily keeping up with cost of living. And so that is a stretch for many countries.
What about hiring in tech?
I
know that's very, very broad, but
that's a big topic. It has really changed. A few years ago we would talk about digital talent. We don't really talk about that anymore. It's too broad of a topic. It doesn't really mean anything anymore, actually. It's lots of different things. So we talk about AI engineering talent. That is the most sought after technology talent at the moment, and demand far outstrips supply. And so actually other types of talent, for example, the classic CTO role or chief digital officer role, doesn't really exist anymore. We're seeing those roles get spread out into different areas, get pushed into retail, get pushed into different parts of the business. So it's really become more fragmented, actually, in terms of tech hiring. We still see India as really a powerhouse in terms of future tech talent, and particularly impressive is how they're investing in AI. It is interesting to see how countries, mostly kind of the BRIC countries, are investing in AI more heavily than, for example, the Europeans. So I think as we look forward, there's a real opportunity for BRIC countries, emerging economies, to step up.
I think as well, though, and I think about some of the roles that these more emerging economies do. It's things like call centres, for instance, or support staff that is going to be really easily replaced by AI. What are you seeing on that front in terms of planned, essentially it is planned headcount reductions. We've already seen them, for instance, from Salesforce or Microsoft. Who else is going to be following?
Yes. Actually, we are continuing to see global centres grow in India and the Philippines, which I'm a little surprised at. It's been there for a long time, but they're continuing to grow. And it's both a cost play and a productivity play. So yes, some of those specific types of work can be replaced by AI. However, they get reoriented in something else. So workforces, in some cases, are being laid off. In some cases, they're just getting more and more productive.
I also just came into my mind, of course, Middle East is a region that's investing so heavily in AI. And also I think it's very interesting to watch the developments between Asia and the Middle East. But what is that relationship looking like?
Yeah, it's getting stronger and stronger. I think, the GCC countries have invested heavily into both kind of knowledge worker talent as well as broader workforce talent. They've got a very, very young workforce, actually, which I think will be as transformative as AI. They've got millennials and Gen Z will be the majority in a year or so. And this is going to be a very different workplace, particularly for the Middle East. So it's going to be really interesting to see. And of course, they've got great ambitions to diversify and be part of the global economy. You know, so the other noise in the Middle East is very distracting and certainly unwelcome.
We were just anecdotal. I was having this conversation with a couple of people this week, and it seems like the younger generation don't have to worry about leveling up in AI because it's really part of what they do and what they study. It's really the middle manager to the upper management that sort of have to catch up. And I wonder, from your perspective, what are the baseline sort of AI proficiency skills that employers or you think executives should be forcing themselves to learn and just get their heads around?
Yeah, I'm of the generation that only kind of opened a computer when I was finishing my degree, when I was sending a resume off. And so we definitely have a completely different muscle when it comes to this than the Gen Zs and the Gen Alphas coming through. The key trait that we find whenever we look for recruiting and executives is curiosity. And whether it is for ability to adopt new tech, ability to go into new markets, if people have curiosity, they will learn, and it doesn't matter how old they are. And so when we've studied this across multiple generations, it doesn't matter actually how old you are. You can be in your 50s or 60s or 70s, and if you have curiosity and learning agility and interest in learning, you will pick it up. So when it comes to understanding people and moving your workforce, it's the traits as much as the technical training. You're looking for people who are curious and interested to learn. Put the training in front of them, and they'll go for it.
Okay. Final question for you, I guess, risking oversimplifying, using you guys as a proxy for the global economy. Do you get a sense that hiring is going to pick up generally, or is it the opposite?
I do think hiring is going to pick up in select countries. Not universally. I think the US is going to be uncertain for a while. I think we're seeing countries like Malaysia really, really pick up. We're seeing India pick up. We're seeing Japan pick up. Australia actually is also looking good with a lot of investment in real estate. So it's very different depending on what your economy is looking at.
Esther, fantastic to have you. Feels like we should do this more often. Yeah. There's a lot of uncertainty to navigate, isn't there? All right. Esther Colwill, APAC president at Korn Ferry. And for our Bloomberg subscribers, you can watch that. If you didn't catch it live, you can scroll back, of course, on TV Go and catch more of the interview we just did, or also catch up with other stories you might have missed throughout the programming today. Plenty more ahead here on The China Show. Check that out, by the way, on TV Go for our clients. This is Bloomberg. Right, welcome back. We're looking at baby-related stocks still. There was an initial spike high across some of the ones that were trading when the news broke, and we'll get to the news in a moment here, but now we've since paired most and reversed, if not all of the gains in many of these names. Do we have them on the screens? Anyway, just take my word for it. Oh, there we go. Thank you so much. The story here was Bloomberg has learned that China is planning to offer financial incentives to encourage couples to have more children. Let's bring in Stephen Engel, our Chief North Asia correspondent, for what we know so far about this.
Your fertility correspondent here, right?
Yes.
So, China, we all know, had the one-child policy, and it was basically relaxed and scrapped about a decade ago, 9 years ago, 2016. We had a surge in new births then at 18.8 million in 2016. That has dropped down to last year was 9.54, about half. So the birth rate has dropped considerably, along with marriages. Marriages are at about a low of nearly half a century low. So people are not having babies. They're not getting married. That is a serious threat to productivity. Obviously, the labor force in China. Some of these projections for the demographic shift in China is that we could see China, which is already ceded to India, the title as being the most populous nation back in 2023. But that population is projected by 2050 to go to 1.3 billion and to 800 million by 2100. So 75 years from now, when I will be long gone, you guys will still be around. The population down to about 800 million. But AI will have all our jobs by then anyway, right? So they're going to be offering up some welfareism, if you will. Cash handouts to families willing to have a child, about 3,600 yuan. It's about $503 per child per year for the first 3 years if they have a baby by January 1st or later of this year.
I think, though, you pointed to sort of the broader issue, which is that even if you do put that cash on the table, it doesn't mean that it's actually going to really encourage people to have more kids, because there's those broader societal shifts that are underway. So I guess that also points to the next question for government, which is either what would be the step that they would take in the direction, what could further incentivize people, or are they doing enough right now to prepare for a situation where they just don't have a big enough labor force?
Right. So, I mean, it goes to the broader issue of a personal safety net. There's no iron rice bowl, if you will, anymore. And that's why people have been saving their money and not spending it in times of uncertainty right now. The cost of getting married is so much higher now, to the point where, you know, there was tradition where the groom's family would provide a house. You'd have to have a house before you get married.
And then a car is the other side.
And then in the international schools for the child, it's a very costly proposition, obviously. So people are holding off from getting married. So what are the incentives? Because $500 a year doesn't sound a lot. You know, China is not the cheap place it used to be. $500, 3,600 yuan will not go far at all in China. So again, I think you raise a very good question. How much would this go? In an urban household, probably this would not incentivize having a child. But in the countryside, perhaps, yes, that would. So, but yes, they have serious demographic issues.
Yeah, and it's to the point that you were making in Bell as well. Like, these are broader societal changes, right? And it's not just in China. I remember when you look at the sort of the tax regime in Hong Kong, you do get tax breaks on years when your kid is actually born. And I'm not sure, actually, I haven't had to look at the data, whether or not that's actually led to people having more. I mean, you do get more money in your pocket, and whether or not it incentivizes people not just to have children, but to get married altogether.
I think actually Hong Kong has a faster aging population than even mainland China.
Yeah, and Japan does. Japan has been graying for a long, long time.
Singapore.
Yeah, so
Japan,
there have to be a lot more societal issues, and as far as sponsored daycare, perhaps, as well, that's something in Japan that they've been talking about for a long time, because dual-income households have become much more common across Asia, and including in China, to combat some of those higher prices that these households are facing. So again, they realize that this is a demographic problem and ultimately a productivity problem, and therefore a competitive issue on the global stage. And this is maybe just the first step, obviously.
All right, that was our Chief North Asia correspondent, Stephen Engel, there. And we can get to what has been the most read story on the terminal this morning. So we'll start with the background, which is that India's market regulator is barring Jane Street from access to its local securities market. SEBI also plans to seize $570 million of what it calls unlawful gains from the US trading firm. That's after an investigation into derivatives trades that generated billions of dollars. So that's the sort of context, and the response as well came in the last couple of minutes, but essentially Jane Street is disputing, or says that they're disputing those findings. But let's get the details with senior reporter Abhishek Vishnoi. So Abhishek, just for people that are unfamiliar, I mean, is this something that has caught people by surprise, or was this anticipated?
Yeah, of course it has caught people by surprise. It's going to send a chill down HFT, algo traders, proprietary traders, which became part of SEBI's broader investigation. Well, if this fine materializes, this will possibly be the biggest record fine on a foreign entity of this kind, if not the biggest fine ever employed by SEBI. And even if it leads to settlement, which usually happens with cases of SEBI or those that get referred to the SEBI appellate tribunal, it might be a record settlement amount as well. Now, this has very broad implications. This is coming in at a time when India is donning the crown of the world's biggest derivatives markets by contracts. And this has, implications on both sides. I was talking to a lot of market participants. It may look like a socialist move. It looks like India is very much still an emerging market. But to be fair to the regulator, Jane Street made $2.3 billion out of India, which is more than 10% of their revenue. And India's market cap is nowhere near 10% of the world. So, that puts the context, in SEBI's study that had come out and said that 90% of traders on the other end, retail and others, which are not proprietary, not algo, not HFT, were losing money. So they were losing out on India's story. So I think it just shows that regulator is now very well aware that there are not enough guardrails in place, that there are many market inefficiencies that are getting exploited, and they would not want the India's dividend to fizzle out like that. So definitely we can see regulations moving into this direction. Definitely we can see some read-through to citadels of the world, to brokers who are actually allowing entry of HFTs and algos to India. There might be some business impact, and to exchanges as well. NSE is not listed, BSE is. So BSE's volumes, what happens to that? They might dry up a little bit. And what happens to NSE IPO? I mean, NSE IPO was just getting started, and now you have this, and NSE has 80-90% of the derivatives market share. So it's going to have profound implications, right from derivatives to cash to secondary to primary markets.
It's a tricky proposition, because at what point do you say those are unlawful gains, and at one point do you disincentivize capitalism? I know that's a fairly broad topic, because the reason I bring that up, Abby, this is a 105-page interim order, and then part of it actually says, and correct me if I'm wrong, that this all goes away if they deposit the amount back. Is my reading of the situation correct?
That's right. David, you have to keep the context of what SEC does in these kind of cases. There have been fines which have run over $1 billion in at least a couple of cases in 2022, if I'm right. And, that puts the context. That's why I was saying that there are, people on both sides. It may look like a move by an EM, but it's very much a DM-like move as well. Whenever there is market manipulation in the US, there are fines which are running, close to $1 billion. Now, unlawful gains, well, it's not the $2.3 billion that are in question. It's the $560 million that SEBI has put it out. So, a case could be made why, let the other $2 billion, stay away from this gamut of fines. Why only $570 million? There are questions like what happens to, those amounts that were garnered by traders which moved from one company like Jane Street to the other company, let's say Millennium, right? So there are these questions that need to be worked out. And yes, it can be seen, if you look at the fines that SEC makes, as a sign of market maturing. India is the world's biggest derivatives market by contracts. It is one of the biggest cash equity market as well. And it is also a sign that it is still very much, in that realm of an emerging market where, if you're making too much money, from market inefficiencies, which regulator thinks are unlawful, there would be fine, there would be implications.
Abby, thank you so much. Abhishek Vishnoi there, our senior Asia equities reporter. Just very quickly, going into the open of India, of course, and we're looking at futures right now. I guess this is a big story. It's a developing story. Isn't it? Is there anything in the futures market that reflects this? Perhaps, perhaps not. Plenty more ahead. This is Bloomberg. Another day, another time, we're talking about HIBOR. Well, why not? In the next few minutes, of course, we'll be getting that coming out. And the fact is, it's remained quite low despite what's been taking place directly in the exchange rate market with interventions taking place. At what point does this spike up, if it does, given all the interventions taking place on the weaker end of the band, and of course, Hong Kong dollar being bought incrementally 3 times this week, bigger and bigger amounts by the HKMA. But yeah, that's a story to track.
Yeah, gyrations there, gyrations in Thailand too. It's certainly been a big week for political chaos essentially over there. But coming up in just a few minutes, an interview with the president of the Thai Stock Exchange, an exclusive with Haslinda Amin on Insight. Happy weekend, everyone. You're watching The China Show.